Hello guys, how you doing? Today I'm gonna show you the ultimate candlestick patterns, which can be divided into continuation patterns, bullish reversal patterns, and bearish reversal patterns. The daily candlestick chart shows the securities open, high, low, and close price for the day. The candlestick's wide or rectangular part is called the real body, which shows the link between opening and closing prices. You should know the opening in the red is not in the same level as in the green. For the red, it's in the top, and for the green, it's in the bottom, and it's the opposite for the close. Let's start with the bullish candlestick pattern. The first one is the hammer. It's a candlestick pattern that is formed at the end of the downtrend and signals a bullish reversal. The real body of this candle is small and is located at the top with a lower shadow, which should be more than twice the real body. This candlestick chart pattern has no or little up shadow. Important to know, the psychology behind this candle formation is that the price opened and sellers pushed down the prices. Piercing pattern is a multiple candlestick chart pattern formed after a downtrend indicating a bullish reversal. Two candles form it. The first candle being a bearish candle, which indicates the continuation of the downtrend. The second candle is a bullish candle which opens the gap down but closes more than 15 of the real body of the previous candle, which shows that the bulls are back in the market and a bullish reversal is going to take place. Bullish engulfing is a multiple candlestick chart pattern that is formed after a downtrend indicating a bullish reversal. It's formed by two candles. The second candlestick engulfing the first candlestick. The first candle is a bearish candle that indicates the continuation of the downtrend. The second candlestick is a long bullish candle that completely engulfing the first candle and shows that the bulls are back in the market. The morning star is a multiple candlestick chart pattern which is formed after a downtrend indicating a bullish reversal. It's made of three candlesticks, the first being a bearish candle, the second a doji, and the third being a bullish candle. The first candle shows continuation of the downtrend. The second candle being a doji indicates indecision in the market. The morning star is a multiple candlestick chart pattern which is formed after a downtrend indicating a bullish reversal. It's made of three candlesticks, the first being a bearish candle, the second a doji, and the third being a bullish candle. The first candle shows continuation of the downtrend. The second candle being a doji indicates indecision in the market. The third bullish candle shows that the bulls are back in the market and the reversal will take place. Important to note, the second candle should be completely out of the real bodies of the first and third candles. The three white soldiers is a multiple candlestick pattern that is formed after a downtrend indicating a bullish reversal. These candlestick charts are made of three long bullish bodies which do not have a long shadows and are open within the real body of the previous candle in the pattern. The white Marubozu is a single candlestick pattern that is formed after a downtrend indicating a bullish reversal. This candlestick has a long bullish body with no upper or lower shadows, which shows that the bulls are exerting buying pressure and the markets may turn bullish. The three inside up is a multiple candlestick pattern which is formed after a downtrend indicating bullish reversal. It consists of three candlesticks, the first being a long bearish candle, the second candlestick being a small bullish candle which should be in the range the first candlestick. The third candlestick should be a long bullish candlestick confirming the bullish reversal. The Bullish Harami is a multiple candlestick chart pattern which is formed after a downtrend indicating bullish reversal. It consists of two candlestick charts, the first candlestick being a tall bearish candle and second being a small bullish candle which should be in the range of the first candlestick. The first bearish candle shows the continuation of the bearish trend and the second candle shows that the bulls are back in the market. The Tweezer Bottom candlestick pattern is a bullish reversal candlestick pattern that is formed at the end of the downtrend. It consists of two candlesticks, the first one being bearish and the second one being bullish candlestick. Both the candlesticks make almost or the same low. When the Tweezer Bottom candlestick pattern is formed, the prior trend is a downtrend. A bearish tweezer candlestick is formed which looks like the continuation of the ongoing downtrend. On the next day, the second day's bullish candle's low indicates a support level. The bottommost candles with almost the same low indicate the strength of the support and also signal that the downtrend may get reversed to form an uptrend. Due to this, the bulls step into action and move the price upwards. Important to know, this bullish reversal is confirmed the next day when the bullish candle is formed. An inverted hammer is formed at the end of the downtrend and gives a bullish reversal signal. In this candlestick, the real body is located at the end and there is a long upper shadow. It is the inverse of the hammer candlestick pattern. This pattern is formed when the opening and closing price are near to each other and the upper shadow should be more than twice the real body. The tree outside up is multiple candlestick pattern which is formed after a downtrend indicating a bullish reversal. It consists of three candlesticks, the first being a short bearish candle, the second candlestick being a large bullish candle which should cover the first candlestick. The third candlestick should be a long bullish candlestick confirming the bullish reversal. The on-neck pattern occurs after a downtrend when a long real-bodied bearish candle is followed by a small real-bodied bullish candle which gaps down on the open, but then closes near the prior candle's close. The pattern is called a neckline because the two closing prices are the same or almost the same across the two candles, forming a horizontal neckline. The bullish counterattack pattern is a bullish reversal pattern that predicts the upcoming reversal of the current downtrend in the market. This candlestick pattern is a two-bar pattern that appears during a downtrend in the market. Important to know, there are some conditions to be a bullish counterattack pattern. There must be a strong downtrend in the market for the formation of the bullish counterattack pattern. First candle must be a long black candle with a real body. The second candle must also be a long, ideally equal in size to the first candle, but a white candle with a real body. The second candle must close near the close of the first candle. Now we're gonna start the bearish candlestick patterns which indicate that the ongoing uptrend is going to reverse to a downtrend. Hanging man is a single candlestick pattern which is formed at the end of an uptrend and signals bearish reversal. The real body of this candle is small and is located at the top with a lower shadow which should be more than the twice of the real body. This candlestick pattern has no or little upper shadow. Important to know, the psychology behind this candle formation is that the price opened and seller pushed down the prices. Suddenly, the buyers come into the market and pushed the prices up but were unsuccessful in doing so as the prices closed below the opening price. The dark cloud cover is a multiple candlestick pattern which is formed after the uptrend indicating bearish reversal. It is formed by two candles, the first candle being a bullish candle which indicates the continuation of the uptrend. The second candle is a bearish candle which opens gap up but closes more than 15 of the real body of the previous candle, which shows that the bears are back in the market and the bearish reversal is going to take place. The bearish engulfing is a multiple candlestick pattern that is formed after an uptrend indicating a bearish reversal. It is formed by two candles, the second candlestick engulfing the first candlestick. The first candle, being a bullish candle, indicates the continuation of the uptrend. The second candlestick chart is a long bearish candle that completely engulfs the first candle and shows that the bears are back in the market. The evening star is a multiple candlestick pattern which is formed after the uptrend indicating bearish reversal. It is made of three candlesticks, first being a bullish candle, second a doji, and third being a bearish candle. The first candle shows the continuation of the uptrend. The second candle, being a doji, indicates indecision in the market, and the third bearish candle shows that the bears are back in the market and reversal is going to take place. Important to know, the second candle should be completely out of the real bodies of first and third candle. The three black crows is multiple candlestick pattern which is formed after an uptrend indicating bearish reversal. These candlesticks are made of 3 long bearish bodies which do not have long shadows and open within the real body of the previous candle in the pattern. The black Marubozu is a single candlestick pattern which is formed after an uptrend indicating bearish reversal. This candlestick chart has a long bearish body with no upper or lower shadows, which shows that the bears are exerting selling pressure and the markets may turn bearish. The tree inside down is multiple candlestick pattern which is formed after an uptrend indicating bearish reversal. It consists of 3 candlesticks, the first being a long bullish candle, the second candlestick being a small bearish which should be in the range the first candlestick. The third candlestick chart should be a long bearish candlestick confirming the bearish reversal. The relationship of the first and second candlestick should be of the Bearish Harami candlestick pattern. The Bearish Harami is a multiple candlestick pattern which is formed after the uptrend indicating bearish reversal. It consists of 2 candlesticks, the first candlestick being a tall bullish candle and second being a small bearish candle which should be in the range of the first candlestick chart. The first bullish candle shows the continuation of the bullish trend and the second candle shows that the bears are back in the market. The shooting star is formed at the end on the uptrend and gives bearish reversal signal. In this candlestick chart, the real body is located at the end and there is long upper shadow. It is the inverse of the hanging man candlestick pattern. This pattern is formed when the opening and closing price are near to each other and the upper shadow should be more than the twice of the real body. The Tweezer top pattern is a bearish reversal candlestick pattern that is formed at the end of an uptrend. It consists of 2 candlesticks, the first one being bullish and the second one being bearish candlestick. Both the Tweezer candlestick make almost all the same high. When the Tweezer top candlestick pattern is formed, the prior trend is an uptrend. Bullish candlestick is formed which looks like the continuation of the ongoing uptrend. Important to know, on the next day, the high of the second day's bearish candle's high indicates a resistance level. Both seem to rise the price upward, but now they are not willing to buy at higher prices. The tree outside down is a multiple candlestick pattern which is formed after an uptrend indicating bearish reversal. It consists of 3 candlesticks, the first being a short bullish candle, the second candlestick being a large bearish candle which should cover the first candlestick. The third candlestick should be a long bearish candlestick confirming the bearish reversal. The bearish counterattack candlestick pattern is a bearish reversal pattern that appears during an uptrend in the market. It predicts that the current uptrend in the market will make and the new downtrend will take over the market. And now we're gonna see the continuation candlestick patterns. The Doji pattern is a candlestick pattern of indecision which is formed when the opening and closing prices are almost equal. It's formed when both the bulls and bears are fighting to control prices but nobody succeeds in gaining full control of the prices. The candlestick pattern looks like a cross with very small rear body and long shadows. The spinning top candlestick pattern is same as the Doji, indicating indecision in the market. The only difference between spinning top and Doji is their formation. The rear body of the spinning is larger as compared to Doji. The falling tree method is a bearish 5 candle continuation pattern which signals an interruption but not a reversal. I repeat, not a reversal of the ongoing downtrend. The candlestick pattern is made of 2 long candlestick shots in the direction of the trend. It means downtrend at the beginning and the end, with 3 shorter counter-trend candlesticks in the middle. The candlestick pattern is important as it shows traders that the bulls still do not have enough power to reverse the trend. The rising tree method is a bullish 5 candle continuation pattern which signals an interruption but not a reversal of the ongoing uptrend. The candlestick pattern is made of 2 long candlesticks in the direction of the trend, it meaning uptrend in this case. at the beginning and the end, with 3 shorter counter trend candlesticks in the middle. The candlestick pattern is important as it shows traders that the bears still do not have enough power to reverse the trend. The upside Tasuki Gap is a bullish continuation candlestick pattern which is formed in an ongoing uptrend. This candlestick pattern consists of 3 candles. The first candlestick is a long-bodied bullish candlestick, and the second candlestick is also a bullish candlestick chart formed after a gap up. The third candlestick is a bearish candle that closes in the gap formed between these first 2 bullish candles. The downside Tasuki Gap is a bearish continuation candlestick pattern which is formed in an ongoing downtrend. This candlestick pattern consists of 3 candles. The first candlestick is a long-bodied bearish candlestick, and the second candlestick is also a bearish candlestick formed after a gap down. The third candlestick is a bullish candle that closes in the gap formed between these first 2 bearish candles. A mat holder pattern is a candlestick formation indicating the continuation of a prior trend. There can be either bearish or bullish mat holder patterns. A bullish pattern begins with a large bullish candle followed by a gap higher and 3 small candles which move lower. These candles must stay above the low of the first candle. The fifth candle is a large candle that moves to the upside again. The pattern occurs within an overall uptrend. The rising window is a candlestick pattern consisting of 2 bullish candlesticks with a gap between them. The gap is a space between the high and low of 2 candlesticks that occurs due to high trading volatility. It is a trend continuation candlestick pattern indicating strong strength of buyers in the markets. The failing window is like a rising window, but consists of 2 bearish candlesticks, and it's an indication of the strong strength of sellers in the market. The higher wave candlestick pattern is an indecision pattern that shows the market is neither bullish nor bearish. It mostly occurs at support and resistance levels. This is where bearish and bullish battle each other in the effort of trying to push the price in the given direction. Candlesticks depict the pattern with long lower shadows and long upper wicks. Likewise, they have small bodies. The long wicks signal there was a large amount of price movement during the given period. However, the price ultimately ended up closing near the opening price. You can subscribe for the latest market, earning report, economy calendar, news, and other videos.